When it comes to investing, there's this huge debate, a fundamental question that really splits people. It puts two really powerful ideas head to head, and today we're going to dig in and see which one really holds up. So, what's the smarter move? Are you supposed to hunt for a bargain, a company you can buy for a super cheap price? Or should you focus on finding a really high-quality business, even if it means paying a bit of a premium? This isn't just some theoretical debate. It's the core tension we're going to unravel today. And we're going to do it using some amazing research from Robert Novimarks. All right, so let's start with the classic playbook. The one that built fortunes and has been the gospel for generations of investors. This quote really gets to the heart of traditional value investing, the kind of stuff Graham and Dodd were famous for. And the idea, honestly, it's brilliantly simple. Find companies where the stock market price is way lower than the value of all their actual stuff. Their factories, their inventory, the cash in the bank. It just makes sense, right? I mean, if a company's stock is trading for less than what its assets are worth on paper, it feels like you're getting more than you paid for. It's kind of like finding a designer jacket at a thrift store. You just feel like you found a hidden gem. Aha, but here's the catch. This is where that simple logic starts to get a little shaky. It's that nagging doubt that I'm sure keeps a lot of value investors up at night. Is this thing really a bargain, or is it just junk? Is the market actually right and this company is heading for trouble? And this is where our story gets way more interesting. So what if we stopped rummaging through that bargain bin for a second? What if we looked for a totally different sign of quality? What if we focused less on how cheap a company is and more on how good it is at its actual core business? And this slide shows you the critical difference. See, on the left, you've got earnings. It's that famous bottom line number everybody talks about. But the problem is, it can get really messy, all polluted with different accounting rules, R&D spending, big ad budgets. But then look to the right, you have gross profit. And that is a much cleaner, clearer signal. It tells you one simple thing. How much cash is this company making from selling its products before all that other noise gets in the way? So, the key is how we measure this. And the research gives us this really simple, kind of elegant metric, gross profitability. All you do is take that gross profit number and divide it by the company's total assets. Just think of it like this. For every single dollar of stuff a company owns, how much raw profit is it able to squeeze out? It's just a pure measure of how efficient the business really is. Okay, so now we have our two clues. Cheapness, which we measure by book value, and quality, measured by this gross profitability idea. So what happens when you actually test them against each other? Well, the answer is probably not what you're expecting. The data is just crystal clear. When you sort companies using this gross profitability metric, the most profitable ones, the ones that are absolute rock stars at their core business, they generate way higher stock returns than the least profitable ones. So it kind of seems like quality is the clear winner here. And that seems pretty logical, doesn't it? I mean, if these companies are producing such great returns, they must be what we call value stocks. The market must be missing how great they are. Makes perfect sense. And boom, there it is. The big paradox at the heart of this whole thing. These super profitable, high-returning companies, they don't look cheap at all. In fact, by all the traditional yardsticks, they look expensive. They look like what everyone calls growth stocks. I mean, just look at the data for yourself. You can see right here, the companies with the highest profitability have a book-to-market ratio of just 0.33. That screams growth stock. And then you flip it. The least profitable companies have a ratio of 1.10, which is textbook value stock territory. It's a total paradox. The two strategies that work are pointing in completely opposite directions. So what on earth do you do with two winning strategies that seem to be complete opposites? Well, what happens if instead of trying to choose between them, you just combine them? This is where the magic happens. The research found that the returns from these two strategies are negatively correlated. Now, in simple terms, that means when one is having a bad year, the other tends to be having a good year. They act like a seesaw, perfectly balancing each other out and giving you this natural hedge when things get choppy. So what does this look like in practice? Well, check out the results. When you smash them together, something really powerful happens. On their own, both value and profitability deliver really solid monthly returns. But then, look at that 50-50 mix. It basically grabs the best of both worlds, and you end up with a significantly higher return overall. But here's the real kicker. It's not just about juicing your returns. This is the truly amazing part.
Because they hedge each other, that combined strategy is actually less volatile, less risky than the value strategy all by itself. So you're getting more return for less risk. And that brings us to this incredible number, 0.85. This is the combined strategy's annual Sharpe ratio. Now, the Sharpe ratio is basically the ultimate bang for your buck metric in investing. It tells you how much return you're getting for the amount of risk you're taking. The higher the number, the better the deal.
And just to put that 0.85 into perspective, get a load of this. The Sharpe ratio for the entire stock market during that same time, just 0.34. So this combined value and profitability strategy delivered 2.5 times the risk-adjusted return of just owning the market. I mean, that is an absolutely staggering difference. All right, we've gone from cheap stocks to quality businesses, and we've seen how putting them together creates something brand new. So what's the big idea you should walk away with? Well, first, this really forces us to rethink what value even means. It isn't just about a low price. Real value might be in how productively a company uses its assets. Second, profitability is like this amazing quality filter. It helps you steer clear of those cheap-for-a-reason companies, the value traps. And finally, by combining these two opposite ideas, you don't have to choose. You can build a strategy that's stronger, smoother, and just plain more robust than either one on its own.
So ultimately, this whole thing leaves us with a really important question to ask ourselves. It challenges those old rules and shows us there's another side to the story, a side that's not so obsessed with the price you pay, but is focused on the quality of the business you're actually getting. It's asking us to look past the price tag and instead focus on that engine of profitability that truly drives returns over the long run.